Where do mortgage rates come from and what makes them go up or down? One of the big misconceptions I often hear is people think that banks set the rate. The truth is that Fannie Mae and Freddie Mac pool together all these mortgages and they sell them to investors on Wall Street. These trade as a bond called a mortgage-backed security. So I want to show you exactly how these function. This is a real-time trading feed of mortgage-backed securities. It's a bond, like I mentioned. Each of these bars represents a day of trading. Up is good for rates, down is bad for rates. Now, the key thing to point out is that rates don't go up or down unless this goes up or down. Now, let's correlate this with stocks because I think we understand stocks a little bit better. Let's say on this day right here, you wanted to buy Apple stock. Now, the price that you get for Apple stock is where that stock is trading when you put your buy order in. Now, with mortgage rates, the rate that you get is where this instrument is trading when you lock your loan. Typically, we lock between 30 and 45 days out from closing. So imagine again that you went this day to Edward Jones and you said, I want to buy Apple stock. How much is Apple stock? They're going to give you a price. If you ran across the street and asked Charles Schwab, they're going to give you the same price because they don't set the price. The market does. But if you asked Edward Jones here and then, you wanted to shop around, but things got in the way and you got kind of busy and you waited 1 day, 2 days, you're going to have dramatically different pricing because of that market movement. The same is true with mortgage rates. So that's where rates come from. What makes them go up or down? The number one thing that makes rates go up or down is inflation. So because bonds are a fixed return to an investor over a long period of time, 30 years, then if that return, let's say it's 3%, as inflation increases, the value erodes. And so in order for investors to continue to invest in these types of bonds, rates have to go higher when inflation is rising. So conversely, when inflation comes down, they become more attractive because again, it's a value to the investor. So that's in a abnormal market that we're in right now where there's these huge inflationary pressures right now. In kind of a normal market where there isn't inflation, the things that are going to impact mortgage rates are good news and bad news. And here's what I mean by that. So there's a finite amount of money in the marketplace. So for individuals, they have a finite amount of money that they can invest. For institutional investors, similar. They have just a certain amount of money. Now, when things are going really, really good, so let's say corporate earnings are strong and employment is robust and things look really good, then money gets pulled out of bonds and put into equities in order to take advantage of those gains because equities improve on good news. They improve on good earnings, good job, good economy. The flip side of that is when there's negative news or uncertainty. So if for example, corporate earnings are on the decline, or if unemployment is on the rise, or if there's things geopolitically that are concerning, things that impact supply chain, wars, other economies, other like global economies. Those things will spook the market and people move their money out of equities into the safety of bonds. And that helps mortgage rates. So that's what drives mortgage rates up and down. And I want to show you just the visual of this really quickly, because if we go back to where things began to change, we can find it very specifically right here in kind of mid to late October, really right here on November 1st and October 28th. What happened was we started to see inflation persist. There was the talk of transitory inflation and so forth, but this was really the turning point, was October of 2021. And you can see this massive selling off. So this correlated, this was the highest mortgage-backed securities we had seen in probably 40 some years. And that correlated with the lowest mortgage rates. Then this happened, and there was a massive selling off as inflation was on the rise. Now we're in the highest inflationary market we've seen in 40 plus years, which correlates to the highest mortgage rates we've seen in 40 plus years. So as inflation goes up, mortgage rates go up. As inflation comes down, mortgage rates come down. One of the things that is often misunderstood is when the Fed says they're raising rates, they are raising the Fed funds rate. They can only control one rate, and that's the overnight bank rate, or the Fed funds rate. That's the rate that banks lend money to one another in order to maintain their liquidity, so that they can lend money to their customers. The way that they lend money to their customers are car loans, credit cards, and lines of credit. So those are what are directly impacted when the Fed increases rates. Now, what they're trying to do is slow the economy so that inflation comes down. Historically, every single time that the Fed has intervened in a high inflationary environment, they've done so by raising the Fed funds rate. And as that starts to take hold and the economy slows down, we start to see inflation come down, and then mortgage rates come down. And then the last thing that is going to dictate mortgage rates is your personal profile, let's call it. So prior to 2009, rates were the same for everyone who qualified. But the mortgage reform in 2009 introduced what's called loan level price adjustments, which now factors 30 things into the rate that you're going to get, which becomes very individualized, very similar to life insurance policies. So those are going to vary from one person to the next based on these different factors. Factors like age, weight, lifestyle choices, family medical history, personal medical history, things like that. So these 30 things are now impacting your mortgage rate. So every person's rate is going to be different. Things like the loan type, whether it's VA, USDA, FHA, or conventional, the amount of money that you put down, the amount of cash reserves you have, all of these different things are going to impact the rate through these things called loan level price adjustments. So really the key thing that I'm trying to point out here is that there is a science to this. It's not just someone moving the dial at every individualized lender. It's important that you work with someone that has eyes on the mortgage-backed securities so that they fully understand what's going on and how best to advise their clients on the best lock strategy that aligns with their goals and their budget. So if you have any questions, feel free to reach out anytime. Happy to answer questions, happy to put together specific and custom rate quote. You can catch me at Tony at mymortgageguytony.com. Thanks so much.